I make thousands of dollars trading a support and a resistance strategy. Let me show you the tricks I've learned over the years that I've been trading using them, so you can start out from knowing nothing about support and resistance to knowing what I know now after 5+ years of trading just using support and resistance levels. Now, to quickly go over the basics, the whole idea with support and resistance levels is you have a resistance at the top and support at the bottom. And the whole idea is the market bounces off of resistance levels. Resistance levels usually push the market lower, and support levels usually pushes the market back higher. Now, the first big mistake that I see a lot of people doing is treating support and resistance levels like lines, a specific level of looking for the market to come and hit that exact price. And instead, what I've realized over time is don't treat them like levels, treat them like zones instead. Treat it like an area that you expect the market to come and bounce off of or come into some kind of support or resistance. And the whole idea with this is that you don't know what the market's going to do. The market never replays what it does perfectly. But if you look at this kind of zone up here, this resistance zone at the highs, is that anytime it comes up into this zone, the market gets pushed back down. And you want to be aware of that when you're trading. And the same thing on the flip side, when it comes down to the support area, you want to know that it might potentially bounce there. And so how do you figure out when it's going to bounce and when maybe it's going to break through this level like it does here? But first off, let me talk you through how I end up drawing these zones, because that can be very crucial. Now, some of it is subjective, but what I always do is I go off of the most extreme area or the most extreme high and swing that the market has up into that area. Now, generally a good rule of thumb to draw and know when a resistance level or support level is there is I want to see at least 2 or 3 times that the market has come up into that area with a swing and it's been pushed down. The whole idea is with this is we're just seeing what the market has done before, and knowing what the market has done before is generally a really good predictor of what it's going to do in the future. And so drawing off of these 3 levels right here or swings, you would be able to predict that, okay, when the market comes up here again, I can assume that it might reverse off of this zone I've now created. And now for how far you kind of move the box in, this can depend on the price movement that you kind of see. But a lot of the time, if we kind of zoom in here, is I like to look at, okay, we have it off the highest high, but as well is also thinking about, okay, well, what are these little swings that the market had, and kind of just taking into account, you know, maybe there's a chop area up here as well. And so I want to capture that in my zone, because when the market comes up to the zone again, you don't know where it's going to potentially reverse off of. You just know that somewhere up here, there is going to be a potential for it to reverse. You don't know if it's going to be here, all the way up here where it reverses, or even all the way at the highs. But you want to know that, okay, somewhere up here, the market's going to potentially take a turn, and I can take advantage of that with a couple of other steps that you want to be following. And I'll walk you through kind of how I do that and how I enter in trades off these levels after we've kind of gone through these. And so another huge mistake that I see and that I took a while to kind of figure out is looking at just the extremes of the market. And so whatever chart you're looking at, it doesn't really matter, is look at kind of the big picture and the swings that are going on in the bigger picture of the price action that's happening. And what you want to do is, well, you can see, you know, there's some swings here, there's a swing here. You know, you can make a lot of different levels or zones based on all the little smaller swings that the market has. And what this does is it's going to create too many levels, and you're going to be looking for, if you're looking for reversal trades or the market to bounce off of one of these areas, is you're going to be looking for trades and betting money in areas where the market is less likely to bounce. And so for an example, if the market was trending right here and I put a support level off of these 2 swings right here, which I think is totally reasonable in terms of it's had 2 good bounces here, and you know, you can maybe even see this bounce right here is pretty similar and close. And so maybe you'd think, okay, well, it comes down here again, I'll look for a bounce. But because you're kind of in the middle of this larger range that the market has, it's less likely for that to hold. This is just something I've observed over time, is the market will less likely hold the middle of the range areas. And so you want to just stay away from those. It's better to wait for essentially where the market is stretched so much, where it's so, either sold off in one direction and it's way more likely to reverse, or it's, made such a big move in the other direction that it's over, exhausted. Everyone's already got in the move and it's more likely to reverse. That's the way better way to go about trading reversals, and using support and resistance and knowing when they're going to be more likely to hold is when the market is overextended. And another really big key that I've noticed over time is looking at the velocity, or how fast the market moves off of an area. And so, for example, if we take this initial move that this market had right here, it made a really big move down very quickly. And so for me, what that shows me is, well, whatever happened, and it doesn't necessarily matter what caused this move up here, but for some reason a big move in this market happened, and so it pushed the price down a lot, and that has significance. And so we want to be paying attention to that significance and say, okay, well, for some reason, the price got pushed down really hard from up here, and so I think that makes it more likely that in the future, when it comes up to this again, it's going to get pushed down again. And sometimes, I don't know exactly why this happens. There's so many reasons why, but a good reason can be, well, let's say for some reason, a big bank or investment firm really likes this area in terms of selling and getting out of a position, or betting that it's going to go down up here. And so when it comes up to this price again, well, they're probably going to get in again and, add on to their position. And so that pushes the price down again once it gets up there. And so that's why you can have it where the market will come up to areas multiple times and it just keeps getting pushed lower. All these rules happen on the flip side as well for a support level. Now, the other massive thing that I realized over time was use a larger time frame than what you trade on. And so right now, what we're looking at is a 15-minute chart right here, but I trade on a 1-minute chart. And the whole reason why this is beneficial is because on a bigger time frame, you lose a lot of the noise. You're not really paying attention to all these little micro moves that happen, and you're able to look at the big picture and see, okay, what is the overall structure of what is going on? And you can easily see, okay, there is a big uptrend going on here, here that it's kind of going into a sideways trend, and you're able to easily spot kind of the important areas to where you can look for, kind of clear support and resistance levels and take potential trades off of those. And so that's what I find is really, really crucial as well, is because it just makes it more likely for these levels to hold, and you can draw them and see them on a 15-minute chart, and then you can zoom in to a 1-minute chart like right here. And when the market comes back down to test this area, you can look for a few key things to bet the market is going to go higher off of that support level. So this is a great example of another support and resistance level of how to draw it. Over here, off of this big swing up, you have two really clear bottoms, and as well you have this big move up here. And so, when it comes down here again, you would expect that it bounces, right? Because there was a lot of buying pressure that was in this area. And so I wouldn't necessarily be looking to buy down here because it's one bottom that it's had there. I would wait for it to have these two areas. But then once this happens, I would then pull this across and draw this and have this zone on my chart waiting for the market to come down and hit this level. If it hits this level, you don't know when the markets or what the market's going to do, right? But you can draw these levels and wait for the market to hit them, and either it'll come down and bounce and give you a potential trade that we'll go over in a second, or it'll break through it. And once it breaks through it, if we go back to this example here, there was a decent support level here. It wasn't a great one because it was a little wide in the market. It wasn't as clear definitely as this high up here where the market was clearly bouncing. But once this level got broken through here pretty clearly, I would remove it from my chart and just move on. You can see that the market kind of bounced off of it on the other side here. This is something that some people use. They like the idea of, okay, once the market breaks this support zone, they actually turn it into a resistance zone. And they see that, okay, well, the market might come up here and bounce off of it instead, and it essentially keeps pushing the market lower. And that's not necessarily something that I do, but there's nothing wrong with it. The only reason why I don't do it is because I like to see where the range is developing now and what that looks like. But so once I have these levels drawn and I look at them, I will then go into a smaller time frame chart. Essentially, I'll wait for the market to hit this level down here, and I'll be looking at a 1 minute chart. And so now how do we profit consistently off of the support and resistance levels? And so what I do is, I draw my main zones off of a larger time frame than what I use, which is a 15-minute chart. And then what I do is I go into a 1 minute chart here and I look for a couple of key setups. Now, you don't necessarily have to trade these time frames. This can work on really any market or time frame. The idea is that you're just reading the price movement of the candlesticks. That's kind of how powerful just learning to read the price action can be. You do not need any indicators to really trade, from what I've learned. A lot of them I think are just kind of distractions to make you think like it'll make trading easy. And that's not really something that I've found to be true. And just learning how to read and use, some trend lines here too, that I'll talk about in a second, really help. And so first thing is, when the market kind of comes down to this area, to take a profitable trade off of it, I'm looking for an entry checklist to kind of say, okay, yes, I want to take the risk and bet money that I think this is going to reverse, because inherently, to take a reversal trade, you are betting that a downtrend is going to end and start an uptrend. And that's really hard to do. A lot of people like to think counter trend trading is not the way to trade. And in my experience, I find counter trend trading to be a lot easier than actually trading with the trend, because when you're counter trend trading, you're able to spot where the market's potentially reversing, and you're able to get in on a trade kind of at the lows and then capture a big move. And so your risk reward is really good, where you could be risking, let's say $100, and you could make $300 to $600 on a trade. And so that really pays off, and you don't have to be right all the time to be consistently profitable. And so the first thing I do is I just, again, look at that overall trend of what's going on, because that's the biggest thing, is we need to say, okay, is this trend that's going down into a support level here going to reverse, and is it slowing down? And so often what I use is a trend line. And so you can see I just drew it off of this swing here. We need to zoom out a little bit more to see what the trend looked like, but the market just kind of moved, pulled back, and then it's moved down again. And so I'm just looking at, okay, the most recent trend that it had kind of looked like this, and so I'm just drawing it off of the high here from this swing from when this down move started, and then looking at, okay, well, it kind of had a pullback here and then kept going down. That's a nice little swing to attach this trend line to. And then as well, once it kind of gets down here, there's maybe this here, and then there's maybe this here. But, once this market kind of gets to trading over here, no matter where you kind of move this trend line is clearly broken. That's kind of the big key that you want to be aware of is, okay, this trend line's broken. I can confirm that the trend is broken based on that. But also you can just kind of look at the swings. Here it was clearly just moving down. It was having some smaller pullbacks like here. And then it had this big move down where it accelerated. And then all of a sudden it gave up. And you can see that it snapped kind of back here and it started to switch. And the whole idea when a trend switches is it kind of goes from a phase where it's going down to going to sideways and then shifting. And so, it could go down here after it decides to, consolidate in this consolidation zone. And that's what we're trying to find out, right? Is it going to come down here, consolidate, and go up or go lower? And so that's what I try and confirm with essentially my entry checklist. And so the next kind of big key thing that I was looking at here is that it's made a nice little double bottom here. And once the market starts to make a double bottom, that's a really good signal that if you're just looking at a trend in terms of swing highs and lows, a downtrend is signified by making lower highs and lower lows. And an uptrend is completely the opposite, where it starts making higher highs and higher lows. And so when you get to a point where those start to mix and match, where you're making lower lows and lower highs, but then all of a sudden you have you know, a higher low or a higher high, now you're starting to get into that inflection point and that area where things might start to shift. And so from here, I'm thinking, okay, well, this technically is a lower low, but it's very, very small of a lower low. The market didn't move that much farther down. Versus if you compare, you know, this kind of low right here, if I just zoom in, if you just compare this low right here to this one, you know, the market pulled back here but made another push lower. But the market pulled back here and basically didn't get any further lower. You know, it got a little bit further, you know, by a couple of points, as they're called in futures. But here, it barely got any lower. You know, it basically is a double bottom. You know, it's not an exact double bottom, but again, in trading, don't look for exact price bounces. Those rarely happen. Just look in general. Okay, it's basically bottoming in the same area. And as well, another thing I liked here is this market started to push lower really, really fast. And then it had a massive bullish bar. And so that's something I really, really liked. This is just a really strong reversal pattern on a candlestick pattern level. And so this is something I like to look out for. And I actually have a free 14-page candlestick pattern guide of my favorite candlesticks, which you can find in the link below in the description of this video. And then from there, if I actually pull up the recording of my trade, as you can see, here is just the same things, just kind of different colors. And so what I looked for is I liked this big bullish candlestick and I wanted to see how this next candlestick reacted. Because often I'll see big bullish candlesticks and then the market just reverses kind of right after. And so I wanted to see how it reacted to it. And then so here, I'm looking to say, okay, well, I want to get long if this breaks higher. And so I'm going to put in an order here and look for that to get filled. And so I'm going to put in an order here and essentially bet that the market's going to go higher. And then from there, just to speed this up a little bit, is I put my stop loss below this big candlestick. The idea with this is, well, you know, I think this is a very key level. This big bullish candlestick is giving a lot of important signals that the market is probably found a good support level there. And then of course with the bigger picture support level as well, kind of coupled with that, I think it's a really good spot to look for the market to go higher. And then from there, you kind of just have to sit and wait. You can see I'm kind of down money here initially when the market's kind of pulling back, and it's in that consolidation form, right? It's still in, I've seen enough signals that I think it is going to reverse. But that doesn't mean it's going to happen right away. It could just sit here for a while and then that move could happen, right? And so that's kind of, sometimes you have to hold through that and it's not very fun to do, but it's just a part of trading, right? And then from there, I have a specific way I manage things. I don't like to move up to break even or go for a specific risk target. I usually just kind of go with what the market and move can give me. And so here, once it kind of starts to break, and I think at this point it's clearly shifting from, you know, that consolidation phase. I think it's clearly moving like this, right? But when you think about it, remember, is trends don't just go one direction. It's more likely that it's, you know, going up and then it's going to have a little bit of a pullbacks as it goes up in this new uptrend, right? And so you have to give the trade wiggle room to play out and for the market to just move around however it's going to move. And so just to skip through this, because this trade took a while, even though this is a 1 minute chart, this trade took, you know, I think it was maybe close to 30 minutes, 40 minutes, an hour, we'll see in a minute, to play out. And so here, once the market kind of went into this consolidation form here, I thought, okay, well, maybe it will just reverse on me and I'll just capture a small little win here. You know, it'd still be nice $300-400 with this trade, which is still about 1-to-1. But generally I like to, you know, try and get a little more than that. But I think again, it's just kind of moving with the swings, right? And so I've learned over time is letting things play out and letting the market have that room to potentially go more in your favor. And so you can see up here, we've run into a resistance zone now. And so that's where it's important to be paying attention to these levels when you're in a trade too, is, well, once the market kind of comes up to this level, well, I'm going to expect that it might reverse to the other side now, right? Now, of course, it could break through this. And so I want to give the trade some wiggle room for, you know, it to maybe consolidate here. And again, go through that setup where it decides, okay, does it want to go higher or does it want to reverse? But I don't want to give it too much wiggle room, right? Because, you know, you're up a lot of money at this point. And there's no reason to try and give something too much room, because at some point it is going to reverse and you need to capture some of that money, right? And so here makes this little pullback, breaks this little uptrend that I'm looking at. And so my thinking is, okay, this is a good pullback. It's either going to hold this pullback and keep going higher, or it's going to break this and I am happy getting out, because at that point, otherwise, you don't really have a good spot to have it pull back other than, just kind of having a random spot. And I like to use the price action that I'm reading and how the market's playing out to manage things. And so from there, it holds that level very, very sloppily, I would say. It just kind of sits here in an upwards consolidation area. And so again, it's kind of doing that same thing of it's just kind of consolidating. And so I'm just giving it that wiggle room to play out, because again, I don't know if it's going to, like here, it breaks higher. And so that's me thinking, okay, well, I had another little kind of micro spot here in terms of a resistance level that I was looking at. And then it has this kind of big red candlestick. And so I'm just kind of tightening up that stop loss and then letting, seeing that, okay, if it keeps going, great. And if it doesn't, it doesn't. And that's how I think it's really important to approach trades when you get in them, because it can really, really benefit you when you get in them. And so that's a big thing about trading support and resistance levels, is knowing that they're not going to be this big all the time, but you want to know what you're doing and what you're wanting to manage when they happen, because look, just like that, it can reverse really quickly in the other direction. And so you want to be able to manage them properly to maximize your profit from them. And so I really quickly just went through this strategy here. I actually have a whole timing reversal that I've discovered recently. And so if you want to learn about how the market consistently reverses at a certain time every day, check out this video right here.